Good afternoon. Welcome to our fourth webinar in our Nebraska Farm Bureau's Inside Profitability series for this year. I am Jay Rempe. I'm a senior economist at Nebraska Farm Bureau, and I get to host today's event on this lovely spring day in Nebraska. Thank you very much for joining us. We appreciate your interest in this topic, and we hope you'll get some good information out of today's webinar. Just a brief background on the Inside Profitability series. It is a series of events that focus on topics that are essential to producer profitability. And what we try to do on these webinars is identify topics that our members feel are key to managing and maintaining the economically viable farms and ranches. And we hope that this series will be informative to you and provide you with the information and offer you some tips and tools and value of managing your farm and ranch. And please, if you have any ideas or thoughts on topics that we might cover in one of these webinars, please just let us know. You can email directly to me if you want with a suggestion at jayr@nefb.org. And please, we're always welcome to new ideas and suggestions. Today, we're going to focus on marketing and risk management related to feeder calves. We're in the midst of spring calving season right now. I know some people are done, but some are still in the middle of it. And along with the health care and the care of the calves and the mommy cows, that the producers are thinking about marketing and pricing their calves. And that's what we want to focus on today. This year's a little more complicated in that regard because of some of the things, the volatility that are in the markets, the drought, the rising feed costs, the international conflicts we're seeing. It's a little more difficult this year when you're looking out ahead and trying to figure out what to do. So to help us sort through this all, we have two gentlemen from the University of Nebraska with us, professors with the Department of Agricultural Economics at the University of Nebraska. First, we have Elliot Dennis with us. Elias has been with the UNL since 2019. He has an extension and research appointment, and he focuses on the economics of livestock and marketing and risk management and public policy. He received his PhD from Kansas State, and probably most importantly to me, Elliot listed baseball as one of his hobbies on his resume. So Elliot, I appreciate that. I'm a baseball fan myself. And then we have with us Jay Parsons. Besides having a great name, Jay's been with UNL since 2014. He also has a research and extension appointment and just told me he does some teaching with an emphasis on farm and ranch management, risk management, and decision analysis. And he received his PhD from Colorado State. So we're going to let them give their presentation. And then after the presentation, we'll open it up for questions. If you have a question, please type it in the chat or the Q&A. We'll pick it up. Either Phil Erdman, who's helping us behind the scenes on this webinar, or I will pick it up and we'll make sure the question gets asked. So with that introduction, I think, Jay, you were going to go first. I'll let you jump on and talk to us, share your presentation with us.
Yeah, thanks, Jay. And I'll go ahead and share my screen here. So my task is pretty simple here to start off with, but as far as giving you some background information, and I want to start by giving credit to the North Central Extension Risk Management Education Center. You see their logo up here along with Elliot and my contact information, and they provide funding. We've been successful in getting grants, let's put it that way, in the last few years to do education with livestock and forage producers throughout the state, bringing them up to date on some of the risk management tools that are available to them. And today we're going to focus in on one that pertains to pricing of calves, which is livestock risk protection insurance. So we want to thank them for their continued efforts in providing us the ability to go throughout the state and help people understand some of these tools and how to use them. Having said that, I want to emphasize that neither one of us sell insurance, so we're not necessarily in the business of talking people into getting it. We just want to make sure that people are making educated decisions when it comes to possibly using some of these tools. So my task is to provide some nuts and bolts background on livestock risk protection insurance itself, and then turn it over to Elliot to cover some of the fun stuff with some of those dynamics that Jay was mentioning in his intro. So for those of you that are not familiar with livestock risk protection insurance, or maybe just slightly familiar with it, it is a price protection insurance for cattle producers. It's been around since, it's also available for swine. The swine product has been around since 2002. For cattle, it's been around since 2003. It is available all across the state of Nebraska. Matter of fact, all the lower 48 counties in continental US, it is available for feeder cattle or for fed cattle. And you see the weight classifications here. They split feeder cattle up into a weight 1, which is those animals less than 600 pounds when you plan to market them. And then in weight 2 is for those animals that are in that 600 to 900 pound range. And anything over 900 pound goes into the fed cattle product. And that is tied to the live cattle national price, whereas feeder cattle is tied to the feeder cattle index on the CME, Chicago Mercantile Exchange. So we're going to focus today primarily on the feeder cattle product, which Jay mentioned, but certainly some of the stuff also pertains into the fed cattle, although obviously dealing with different market dynamics there. So in a nutshell, LRP insurance operates like what we call a European put option. That is basically you pay for it up front, or I should say you incur a premium obligation up front, and then it's settled out at the end. There's not the ability necessarily to sell or trade it like you would with a regular put option on the Board of Trade. It is offered in a variety of lengths. Anywhere from 13 weeks would be about a 3-month period, all the way up to 52 weeks. Most people that are looking at this product are looking in that 13, 26-week range, where you're looking 3-6 months out as far as the pricing goes. It is based off of national prices, so producers do remain subject to basis risk, which Elliot will talk a little bit more about in his presentation when he looks at the prices. But suffice it to say, you still are responsible for marketing your cattle in the local markets, getting the best price you can, and that's going to be related to the Board of Trade. The difference between those is what we typically talk about as being the basis, but this does not protect that difference, so to speak. So you are encouraged, of course, to market as best you can and get the best price you can in the local marketplace. So where does this fit on the spectrum? The price that you actually receive for the cash price as you market your cattle is made up, of course, of what's happening out there in the futures contract world or in the national pricing world. And then the difference is what we call the basis that connects it down to the cash price you receive. Now, a lot of people in Nebraska, our data shows that about 70% of people are just going to that auction market and getting a spot price on the day that they sell their cattle. They're accepting the full risk of all of these dynamics. So anything that happens in the local marketplace or anything that happens out on the national marketplace, they're accepting all of that right up until they sell the cattle. The other extreme would be to lock in that price. Video auctions is an example of this most recently, but this can be locked in quite a bit further out if you have a buyer for the cattle that they guarantee you the price and you're all ready to roll there. Then you're not subject to any changes in this because you know what you're going to be getting for them. Some of the tools that we talk about in LRP fits into this toolbox here, similar to a futures contract, but most like a put option in that it is looking at this futures price component here and protecting some of the volatility involved with that, which is really, where some of the big fluctuations are when we talk about markets diving and so on. And then you're really only subject to that basis risk down to the local market price. So like a put option, it's still subject to basis risk. You still have that volatility. It allows you to participate in the upside potential. So if markets go up, you get to participate in that. The only caveat is you have a cost to the insurance, just like if you did a put option on the Board of Trade, you would have a premium cost attached to that. But for LRP, you're not going through a broker. You're not doing a full contract on the Board of Trade. You're basically doing it on a per head basis through an insurance agent. So there's a 2-step process to it. This is basically, it's all done through an RMA approved livestock insurance agent. So it is a USDA government program, and the risk management agency is who administers that. There's an application process where you complete that with a livestock insurance agent that basically gives you the right to actually purchase it. It doesn't obligate you to purchase it. It just connects you with the agent that you're going to be working with. When you actually take out the coverage, it's called a specific coverage endorsement. And this is where you put specific groups in and you say, hey, I want coverage on this type of cattle, this number of head at this weight, for this ending date or endorsement length, and at this coverage price. So that's when you're obligating yourself to a premium. The premium is due at the end of the endorsement period. Now I mentioned that this came online in 2003. LRP remained relatively unchanged for about 15 years. And about 2018, they started making quite a few changes to it. This was one of the more recent changes, and that is that you don't have to pay for the premium until the end of the endorsement period, which makes it nice because you used to have to get a check to your insurance agent when you filled out this specific coverage endorsement at the beginning of that in order to put that coverage in place. So in that regard, it has an advantage over perhaps for a put option, which of course you are obligated to pay a put option premium right up front. So just some semantics, just to be aware of. The crop year for LRP insurance starts July 1 and runs through June 30th. So it is a mid-year to mid-year product. So right now we're in the crop year 2022 for LRP, but keep in mind that when you see data on that, which I'll show you here in a couple of minutes, that data goes back to July 1 of 2021, and it'll carry through to June 30th of this year, and that'll be the 2022 crop year for LRP insurance. They do have a limit. This was initially designed for smaller producers, and it still is relatively targeted that direction, but you can only insure 12,000 head of cattle within this crop year timeframe. This is a six-fold increase from what the old rules were. Used to be, it was 2,000 head. They've increased that at least twice since then, and now you can insure up to 12,000 head in a given year. On a specific coverage endorsement, the limit is 6,000 head per endorsement. And again, that's a six-fold increase. It used to be just 1,000 head. But those are just some limits. Again, it is primarily targeted towards smaller producers. At least initially, it was really targeted towards smaller producers, but they've expanded that quite a bit. So those are things to be aware of as you work through the product. Just some terminology. When you go to take out LRP insurance, you'll see an expected ending value posted on the RMA website that says for this type and this cattle, this is where we expect the price to be at the end of this insurance period. So all of that will be relevant to you on there, and we'll show you a couple of examples of that throughout the webinar today. Coverage prices will also be listed, and of course those are tied to coverage levels, which is just a percentage of that expected ending value. The official range is from 70 to 100%. It never really quite reaches 100%, although it gets pretty darn close to that. So in put option terminology, these are always out of the money slightly when you take them out. Again, the official is down to 70, but very seldom do you see this drop below the mid 80s as far as the coverage level that you can insure. So the premium rates then are tied to the volatility that we see on the Board of Trade as it's working through. The producer will pay a premium. That'll be that premium rate times the total value insured minus the premium subsidy that the government pays, because this is a USDA product and there is a subsidy attached to it. So these are the current subsidy levels. These are what's getting a lot of press lately. Initially, this used to be at 13%. Again, they've made a bunch of improvements in the last 3 years. And now the minimum subsidy is at 35%. That's it if you insure a high level of the price. If you go down to lower levels, it can go all the way down to where they're paying half the premium or more for you. New and beginning producers get an extra 10%. So just add 10% to each of these numbers if you qualify as a new and beginning producer. So that, of course, has piqued a lot of interest in it. And again, just to reiterate, this is tied to the Chicago Mercantile Exchange Feeder Cattle Index. And for those of you familiar with that, those are considered to be steers in that 7 and 8 weight range. So they do make adjustments on the prices. So steers weight 2 in LRP will match up pretty much with that feeder cattle index spot on. If you go down to the lighter weight steers, they add a 10% premium to that price, I shouldn't say premium, 10% increase to that price coverage levels. If you switch over to heifers, they do a 10% discount. So then lightweight heifers are matched up with the heavier weight steers in the feeder cattle one because you're adding 10%, subtracting 10%. One of the new additions was the unborn steers and heifers. So used to be you had to have calves on the ground live, and then you could insure them. Now you can actually insure based off of your projected calf crop. They assume 50-50 on this in terms of the steers and heifers mix. So essentially they take steers weight 1 and heifers weight 1 and average them. That's a fancy way of saying it's 5% above the expected CME feeder cattle index. Premium rates, though, are the same for all of them. And that's important to realize because they're all tied to that same feeder cattle index price. So Elliot's going to walk through some more sophisticated examples, but this is just some numbers I pulled up when I was putting together this PowerPoint presentation. These are numbers I pulled up yesterday just to make them most current. But just to give you an idea, steers weight 2 and heifers weight 1, expected ending value on October 25th. Or so we're looking at, basically we're looking at 7 months from now. We had a 185 expected ending value at that point. So that would be what expected CME feeder cattle index would be. If you drop down to weight class 1, you add 10% to that. That was 203.52. Either case here, you see all it does is just change the coverage prices that you're able to insure, but the coverage levels and the rates are the same because we're all tied to the same volatility. So it's just multiplication across. So you're able to insure at higher levels for the lighter weight steers. Cost, of course, goes up accordingly with that. And then if you insure at the highest price level, of course, it's a 35% subsidy, but if you drop down below 95%, subsidy goes up and so on. So you see some examples here. I'm going to use this top example right here, lightweight steers, just to give you a quick overview of how it works. But that would be at 202.39 coverage price. It would cost you $6.99 to do that. But it's all math, easy math, really. Add 10%, subtract 10% for the heifers, lighter weight, or heavier weight heifers would subtract 10%, be at 166. Unborn steers and heifers, of course, would be the average of the lightweight heifers and lightweight steers, or in other words, 5% above that 185 for 194. But all the coverage levels and rates remain the same throughout there. So this would be an example with 580-pound steers on October 25th at that high coverage rate or coverage price of 202.39. Producer cost would be $6.99 a hundredweight. 150 head, you would just multiply those together and it'd be about a $6,000 premium that you would be obligated to get this coverage in place. That would just remain in place. You'd fill all that out with your insurance agent. And then when October 25th rolled around, they would take a look at the actual ending value and do a comparison. So if they was slightly below, in this case, 195.90, that would say, yes, we owe you an indemnity. So they take the difference of that, multiply it by your coverage weights, be about $5,600. You were on the hook for $6,000 premium. So they'd say, okay, you owe us $435. So you would be writing them a check at this point of $435. That's basically 50 cents a hundredweight. So, your floor would be $195.40, which is basically the coverage price minus your premium. On the other hand, if it went down further, you would have quite a bit of indemnity, in this case down to $183.80. So that would total out to $16,000. In that case, they would say, okay, $16,000's we owe you, you owe us $6, that nets out at $10. That would be what's coming your way. And of course, that would give you $11.60 a hundredweight, which would add back to this and put you right at the same floor. Okay, $195.40. So that's how it's designed to work. Again, it's tied to the national price. I mentioned the premium subsidies going up. We've seen a ton of interest in this in the last few years since they made all these changes to make it more producer friendly. This is data just from the state of Nebraska, and the 2 stars are not included in the average down here because there's still a few contracts out there, obviously, to be worked out on them. But for the decade from 2011 2020, we saw about 154 policies taken out in the state, and you can see how those numbers have doubled and tripled and quadrupled in the case of this year in terms of interest that we have in those. And of course, accordingly, the number of cattle covered has gone up tremendously from what it was before. It's a lot more user friendly and a lot more of it being used in the state. So with that, I'm going to turn it over to Elliot and stop my share. And Elliot's going to walk through some of the pricing dynamics with you and show you a little bit more in terms of how some of this stuff works and how to think about it in our current environment.
Yeah, so thanks, Jay, for that. I think it's helps kind of set the scene for how to use these in matching LRP to current market conditions. And so that's kind of what I've been asked to do. And I think it's no surprise that, we're talking about higher feed inputs. On the feedlot side, we've had drought conditions that are affecting forage conditions. And I think there's just this ongoing issues of supply chain disruptions that really started with COVID. But even before then, we were experiencing some, and now we have a situation that's really heating up to be a combination of what we experienced in 2012 with drought, and also what we experienced back in the industry in 2008 when we had higher input costs. So this is one of the first times that we've really experienced these two conditions simultaneously. And my objective is to kind of show you how LRP can potentially ease some of the pricing concerns that we might have, and some of the uncertainty and price risk that's out there, especially since we're making decisions, right? We're calving right now, and then ultimately we're going to have the opportunity to sell in October. So as Jay mentioned, the LRP is really just a European put option. And so it puts a floor on a price. For kind of reference, I pulled with the CME options contract. This is for the fed cattle contract in April. So if you were to go there and click on this contract, this would be that 141 would be where that contract was trading at. And so if we go right across from this would be what we consider an at the money option. And so we have on the right side, we have puts, and that basically puts a floor. And on the left side, we have calls, and that sets a ceiling. We don't want to pay anything more. And so when we talk about something is out of the money, essentially what happens for put options is we're saying as we decrease this, what we call a strike price or that coverage price, essentially what happens is that premium that we pay should go down. When we work, what we call going in the money, essentially that premium starts to go up. And so I think it's just, sets that stage that these LRP and really work similar to a put option from the CME, and it performs just the same. So, and from that we can draw how our option actually priced, right? So USDA has a website where you can go to and look at those, or if you're working with a livestock insurance agent, or just someone who's a broker who has the ability to sell livestock risk protection, all of those people are going to quote you the exact same premium cost because that's listed by USDA. Now people might have some different fees associated with it, and that's maybe where some of the differentiation is. But really, when we talk about an out of the money put, really what we're talking is intrinsic value ends up going to zero. And so everything is associated with how much time is left in the option. And so one of those things when we talk about what can affect that premium, these are some of the four most common things that can affect that. As producers, we can watch these things and have an idea of how this is going to impact potential premiums as we go to contact our agent or someone who sells this insurance product. That first is the time to expiration. So the longer that we have till that option expires, the costlier it is. That coverage price, or what we sometimes refer to as the strike price, is going to make a difference. If we're trying to insure right, at that money or the highest coverage price, it's going to cost us more. The underlying futures price, we know that as prices for put options, as they start to decline, that premium cost goes up. And of course, price volatility. If we have low amounts of price volatility, which would look something like this, that would be low price volatility. This would be, the price of it over time. That's going to be cheaper it compared to if we have price volatility that looks like that. And ultimately, that premium changes because the underwriter has to say, well, I'm trying to cover my risk. And so you're exchanging that risk with me. And so that premium has to be a reflection of what that risk it actually is in the market. So This is actual data from USDA RMA. Historical data, I chose 1 day, and this is for fed cattle. And so on the left-hand side going up and down, this is the unsubsidized premium cost. And then going from left to right on the bottom, this is that coverage price that Jay was talking about. These different colors represent endorsement lengths. If you remember from Jay's comments, he says that you can insure so many weeks in advance. So that would be 13 weeks, 30 weeks, 43 weeks. And so that's what the different colors or these different line colors represent, is our different endorsement weeks. So let's just, to show how that coverage price impacts the premium, let's just focus on this red color here. What we see is that as the coverage price declines, we actually see this unsubsidized premium cost go down. So that's the idea that if we're choosing on a specific endorsement length and we don't want to cover as much of that final price, well, that premium cost is going to be reduced for us. Now let's just choose a specific coverage price. Let's say 95% coverage. It tends to be a popular coverage choice. And then let's just go all the way up this line, and then we compare across lines. So as we compare across lines, this tells us how much time is left in that option compared across the different endorsement lengths. And so if we're at a 13 length and we're really just wanting to ensure 95% of the coverage, well, what we see is that line just kind of almost vertically just shifts up. Some of that time, that shift is not quite as large. Sometimes it is. This gives us that idea that time remaining in the contract can really change that premium cost that we're going to be paying. So those are probably the two most important considerations, because as producers, if you call someone who's going to be selling you this product, really they're going to say, okay, well, what coverage level and what endorsement length do you want? Those are decisions that you need to make as a producer. And so just understanding how those are really priced and why, excuse me, why those things are different across different contracts. So a couple things to consider, and Jay mentioned this and why this is getting so much attention. And the primary reason is because it's actually potentially cheaper than using CME. So this is some data that have pulled. This is the premium difference between options. And so this would be, the blue line would be the difference between if you were to go and get unsubsidized LRP and just go straight to the CME options and get, these are all at the money. Essentially, before the price premium or that price subsidy, it was actually more expensive to use LRP. I mean, it doesn't take a rocket scientist to tell you that, you know, if something's more expensive, then we're probably not going to use it. And so as Jay showed in his summary of business, there wasn't a lot of use of LRP. And that's primarily because it was, you know, it wasn't really profitable for producers to use. And there was a lot of concerns over how that contract was being settled out. With the new changes in subsidy levels, what we're seeing is that almost a $2 per hundredweight difference across these different contract months. When we look at it at percent, it's almost 25 to 30% cheaper to use LRP versus a traditional put option. Now, the use of this is probably twofold that we're seeing. We have larger brokerage firms who use traditional CME put options or different sorts of risk management, and they're using this, and they're saying, well, we can actually use the same sort of coverage, but we can get it cheaper, so you should use it. And I think on the other side, we have, you know, crop insurance agents who are, you know, working with potentially smaller producers, and there's some interest there. And so some of that demand pull up. I think we'll continue to see a large kind of use of LRP, but I think it's important to note that this is primarily going to be driven off of cost efficiencies of using risk management protection. And the federal government, one of the reasons why they have an invested interest in actually subsidizing producers to manage risk is because they generally have a preference to say, well, we want to pay people to make a management decision to manage risk, rather than pay ad hoc disaster assistance payment programs. Although we've seen some crop insurance that they subsidize crop insurance and they provide ad hoc assistance. So at least in practice, that's their justification for why we should pay people to make a management decision. So what does this look like now? As Jay Remke said, that we are really in the probably middle to late end of calving. Jay Parsons said that, we have this option of unborn calves. And so I thought I'd just, show you what this actually looks like, and how this really compares to, what we've seen historically as far as the pricing of calves. So if you were to go to USDA RMA and look at the coverage prices, this would be the unborn calves here. That's what would be the coverage price. The steer weight one would be here, as Jay mentioned, that's a 10% increase, and this is a 10% discount. And so really just that average, if you were to take the simple average of the feeder steer ones and the heifer steer weight one at 50%, you'd get this unborn. So I think the unborn is actually a huge benefit for producers that I think we'll see a lot more use. This has the opportunity for us to really price in what we believe could be a higher price for us. But it does require us to use historical calving records to make sure we're having an accurate prediction. So if we really think we have a 50-50 split on steers and heifers, then I think using unborn would be sufficient. However, you can pretty much do the same thing with steers and heifers, just using different weights, and have a similar level of coverage that more accurately reflects your calving history. So that premium is really just an average, and on this day it was the 22nd. So I did want to show you this when we're thinking about where we're at in the coverage level, right? So we're at this was the November contract, and so this was at, I think, 98% coverage. And so as Jay Parsons said, that this heifer weight one is going to match closely this feeder cattle CME feeder. So when we look at where these prices are at, we're probably in over the last 25 years, we're probably in that top 10, maybe 12% of pricing for calves at this range. And so really higher prices than we've historically seen, even adjusting for inflation. And so, but we do have some risks that we're facing, right? So probably the biggest thing for cow-calf producers is going to be the uncertainty about forage. The USDA offers a different program, the forage pasture range and forage, but that can be used to help producers pay for reduction forage. But the ability to sign up for that was in December. We have the opportunity then this next year to cover forage production in 2023. And Jay Parsons has done a lot of work in showing how and when pasture range and forage, or sometimes referred to as PRF, pays out. So I think we're important to note that we're in the midst of a cattle cycle, and these prices change when we're specifically talking about a drought, right? When drought occurs, we pretty much have two options, or that we see people have really two options. We can either match the herd to reduce the feed that we have. So that's basically selling early. We say, well, we don't have enough feed, so we're going to match our herd to the feed resources that we have. Or the second option is that we can actually match our feed or buy feed in to match our current herd. And really that decision, what we've seen from a profit maximizing decision over a entire cattle cycle really depends on our assumption about how long this drought is going to occur. So if we believe that drought is only going to be 2 years, then buying in feed is actually the optimal solution there. However, if that drought is 3+ years, the option for herd liquidation early on in the process is actually the better option. So I think there's some uncertainty about whether we're actually going to experience full length drought going into this year. If we did, it would be that third year. This past year, we've seen quite a bit of herd liquidation already. I think some of that has been driven by drought, but on the other hand, we've also seen really high cold cow prices that is driven by the US's really insatiable demand for ground beef. And we import a lot of our ground beef from New Zealand and from Brazil and from Australia. They're in herd rebuilding right now. And so they're not sending as many pounds of beef over to us. And so that's putting further pressure on the ground beef prices, and which is really why we've seen elevated cold cow prices really for the last 6 months. So where is this drought actually occurring? This was the most recent drought map. There will be one released today. And the reason why I point this out is because this gives us an idea of, if drought continues to occur, how much of the beef herd could we see continue to liquidate? The black line here, this oval, represents about, if we were to take that region, it consists of about 50% of all of the beef cows in the United States. If we take that brown line, we're probably in 70% of the beef cow herd is in that area. And so really what we're seeing here is we're seeing matching of where beef cow production has generally occurred and long-term drought conditions. So anytime we see, we can use this legend over here to the right. When we're seeing red, this is an extreme drought condition. And we see parts of that panhandle in Texas under that extreme drought condition, and even parts in Nebraska. And so how have producers responded to these that have really conditions that have happened over this last year? We did see herd liquidation. As I mentioned, some of this was due to drought and some of it was due to higher cold cow prices. But anytime we have a red number, that would suggest that the change in beef cow numbers was less in 2022 than it was in 2021. So our neighbors to the north, South Dakota, had significant herd liquidation, and even North Dakota had, on a percentage basis, had a much larger herd liquidation. Just overall herd liquidation throughout the U.S. We're down about 3% over last year, and so definitely herd liquidation is well underway. This kind of gives us an idea of, that some of these impacts were likely drought induced. And so on the left-hand side, we have the hay stocks that we were going into that were listed for December 2021. And then on this right-hand side, this is the percent change in hay stocks that we had relative to 2020. And so when we're looking about where that drought was, and we match that, if you remember, this is where most of that drought was, in that severe range. And so people were really choosing the option of, I'm going to feed out the hay that I have. And so we've seen kind of that decision. So people are really banking on it, that this is only going to be a 2-year drought. However, as I mentioned, that we are probably potentially into a third year of drought, the way things are shaping up. These conditions do cause liquidation to occur. And so just from historical perspective, that kind of going back to the cattle cycles, this the 2 major times that we've had herd liquidation due to drought was in that 2021 to 2023 range. Excuse me. And then in the 2011 to 2013 range, when we had a pretty severe drought. We did have what we call an input shock that led to some liquidation when we were actually in the process of rebuilding. That was when ethanol really started to become a big hit, and we're starting to build lots of plants, and that put a lot of pressure on corn that subsequently reduced feeder cattle prices. What's unique about this 2020 range, and why some economists are really concerned about that we might over liquidate, is that we have really stacked issues on top of each other. We have drought, that's been going on for a couple of years. we're having an input shock with higher corn prices that we were already experiencing prior to this Ukraine-Russia issue. And that was due to our low stocks to use ratio and a reduced Brazilian corn crop. And now we have even more pressure on the wheat crop, given the reduced exports that we're likely to experience from the Ukraine and Russia region. And on top of that, we just have ongoing supply chain issues. I mean, we've really stopped or the media has really stopped covering COVID, but the effects of that are really starting to work their ways through the supply chain. And so what does this mean if we start to see downward pressure on prices as we work through the production system? What is this going to do for LRP premiums? And so this is really that idea of, should we take an action now or should we wait? But if we do wait, we could potentially be facing higher premiums given to changing market conditions. And so this is what that looks like. So for put options, as this price decreases, what we see is that premium cost increases, right? So that's what that line is really showing. The different dots represent different endorsement lengths. So that red dots represent the 13-week, and that 21-week endorsement is the blue dots, right? We can actually see that, that reduction in that price due to the endorsement length, but this is what that premium actually looks like. So as we start to see that price decrease, we'll potentially due to drought or other conditions, we see that cost to use LRP gets more expensive. This just really speaks to the idea that the time to use risk management is in the prevention stage. It's not in the reactionary phase. And so this is more of goes back to how we manage risk and our philosophy on managing risk. Jay mentioned that there's really two areas that we can manage. We can take all of that cash risk, but we assume all of that variation, but we get all the upside. Or we can pay someone to take some of that variation away, and we get a little lower price, but we feel like that risk is more manageable. LRP fits in that range that, we have the ability to, pay someone to take on risk, and we're willing to accept a little bit lower net price because we have to pay someone to manage that. So this is kind of when we talk about competing forces, we have really this drought and corn prices. And so what does this actually look like for potentially for feeder cattle? So using some published academic research that looks at feeder cattle price differentials and how these feeding margins and corn prices actually impact, this is what some of those lines or potential price discounts and premiums look like for producers. And so what we have is on these different lines represent different corn levels. And so the red line would be if we're at 550 corn, the green line would be if we start experiencing corn at 650, and then the blue line is 750 corn. And so what we see is that, when people can feed high amounts of corn and it's relatively cheap, we actually see the price premium for lighter calves to increase. This makes sense, right? Because it's actually cheaper. We want to pull those animals forward because we feel like we can feed them cheaper than put on the gain more efficiently than on grass. The opposite is true though, right? If we have really expensive corn, we don't want to be placing heavier animals. So how does drought impact this? Well, really what we've seen historically is that all this does is literally just a downward shift on all of these curves. It continues to put that pressure down. And that's just because a lot of animals are coming to market. And so there's not really a rhyme or reason to the weights. And so as all of those animals enter the market, regardless of weight, we really see that price weight slide just vertically shift down. And so in a hypothetical situation, we could see, let's say we're using LRP to manage some of that price risk. And right now, let's say we're just going to be ensuring that 500-pound animals is what we think we're going to sell at. We're going to insure 100 head of steers using historic or current market data to ensure pretty much an at the money LRP, it would cost about $7 per hundredweight, right? But if the prices go below $2 or $200 per hundredweight, then we receive a payout. I think there's a significant chance that if we experience drought and really higher corn prices, that we could see some significant downward pressure on lighter feeder cattle. And so this gives you an idea of, if it goes down even 5%, which would, if we take 550, we're probably at least, a potential increase. And so I think we're potentially at that range, and gives us an option to, still sell at a potentially higher rate. As Jay mentioned, if we don't use LRP, we take all that cash risk, and of course, we're still subject to basis risk. So how do these premiums or using LRP actually help us? I think there's a couple things that we can consider. The first is that it helps us with some cash flow issues, right? And so if we're concerned about maybe being pinched on our operating line of credit, having that premium due at the end of the period could actually help us manage some of that cash flow while still having, a decent amount of price protection. The second is that we have this unique coverage or condition in LRP that allows us to sell up to 60 days prior to the contract expiring. And so really, as producers, you have to really gauge the market. If you put in LRP, you could sell up to 60 days. And if you guess that the market's correctly, you sell at a higher price right before the price declines. And so you sell at a higher price, plus you get the indemnity payout. However, if you kind of mistime the market, you're potentially selling in a low time and prices could rebound. And so you don't actually have an idea. So this is some of that imperfect hedging that we sometimes refer to. Because LRP is so flexible, I think it provides some unique options for producers to price cattle throughout the year. And so let's say we have 100 head, and maybe we think, well, yeah, prices are really good, but prices could be higher in the future. One of those things that we could do is that we could price maybe 25% of the animals now. A couple months, we can price 25% again. A couple other months, another 25%, and then take the last potentially 10, 15, maybe 25% in the cash market. So because LRP allows you to insure pounds and allows you to be flexible with that, that's a potential benefit for producers. And the last is, if we're concerned about what that premium cost could be, there are ways to what we call cheapen up the cost of LRP. And really what that means is if we work with a broker, we can go to the board and basically sell a call option that we receive a premium, and it basically cheapens up some of that cost. However, you do need to work with a broker to put on some of these more sophisticated trading mechanisms, and also understand that there is going to be a difference between when that coverage on the options that we have with CME expire and when LRP will expire. Jay and myself are always welcome to have questions even offline if you want to call us. And I think right now I'll turn it back to you, Jay Rempe, and hopefully we can have some discussion or comments throughout or clarifications on the presentations.
All right, thanks, Elliot, and thank you, Jay. Again, if anybody has any questions, you could please enter them in either the chat or the Q&A function, and either Phil or myself will pick them up and ask. I'll start with lots of good information. One quick question. If I'm a producer and I've never, up to this point, I haven't availed myself of the LRP and haven't used it, what would you guys suggest would be the first few steps that a producer should look like if they're interested in exploring it a little further and using it as a risk management tool?
Yeah, so I'll go ahead and talk about it from the brokerage side, and I'll turn it over to Jay. I think regardless of whether you choose to buy it from a crop insurance agent or someone who's a brokerage firm, I think those are just some considerations. Finding a partner that you feel comfortable with, it's always, but knowing that those prices are going to be, the prices that are quoted are going to be the same across, regardless of who you choose. And Jay, maybe you could talk a little bit about that process of first signing up.
Yeah, and because it is the same, it is really a relationship thing. So if you don't have any clue, RMA does have a find an agent tool on their website that you can go and find who's licensed to sell it in your area. And then the other piece of it, so you can get familiar with some names and make some phone calls that way, but also just talk to other producers, because a lot of them have experience with it at this point, and they'll let you know who they've been working with, and they've been great. They've been getting good relationship there. But those two things, if you don't have a clue, look on the RMA website, see who's licensed, and then just start asking around. Not all crop insurance agents can sell livestock insurance, so there is a separate licensing mechanism there. So.
Thank you. And I'll just add, I know we have several Farm Bureau crop insurance agents that offer the LRP product. So I'd encourage people to check in with their local Farm Bureau agent as well.
Yeah, there's some good ones in the state. So
yeah, we got a question that came in, and for either one, whoever wants to take it. Is there any seasonality to take into consideration when looking at this?
So I'll maybe take that. And so normally when we talk about seasonality in cattle prices, we're talking about, things are going to move a different way throughout the season. That's based upon this really relative supply throughout the year. When we're talking about the seasonality in a coverage price, really it has to do with that time value that's left. And so what we see is that as we get farther or closer and closer to contract expiration, let's say we sell in the middle of November, we're actually going to just slowly see that come down. We're not going to see a November LRP contract be really cheap in the beginning and then rise to be really expensive and then decrease to be really cheap again. What we normally see is this slow decline. We might see bumps up and down given the volatility in the market and what the market's pricing at. But if we really just pick a certain coverage price or a coverage date, then we really just see that we'll call erosion in the time value over time. So a little bit different when we talk about, seasonal pricing in cattle. But so that's how that pricing generally works. And so I think it's best just to figure out when those cattle are ready to sell or when you generally feel like you should sell, and then just start to track that sort of date and coverage price. It's important to note you still sell the cattle in the cash market. This just pays for a potential decline in the national price, which is why we talk about drought or, potential feed costs on it, throughout the US, because these are things that affect the entire production system, not just specific to one area.
Okay, thanks, Elliot. Just a follow-up question. I just want to make sure I understood what you had said earlier, Elliot, but when you were looking at November futures contract prices right now, as you were pricing it on your slide earlier, you made the comment about prices being in the top 10 to 12% of the history, I guess, of prices. Could you clarify that a little more? And what does that mean, I guess, moving out into the future as we go through the year in the summer?
Sure. Yeah, happy to clarify that. So when you look at historical sale barn prices and adjust for inflation, so we call this to be real values of feeder cattle. So essentially we take out all those effects from inflation and we look at where prices are at currently and just really sort those by the date and the price level that we see. Those prices that we are seeing at for the CME that are what they believe November feeder cattle will be at, if those actually basis was entirely zero, we would see that be top 10% of cash prices that producers have ever received since 1995. And so that just kind of sets the idea of if we have potential where given drought and corn prices, that there's potential decreases in or the erosion of the feeder cattle price given these conditions, that pricing in at what we can potentially consider historically high prices seems like something to consider for producers. And if, even though we may feel like, well, there's opportunities that the price could continue to rise, that's entirely true, it could. So using some of that seasonal pricing that's tends to be a little bit more common in grain marketing, and really we're trying to make sure we have the highest average price across all of our pricing mechanisms.
I got one more question that came in by text, and I think it's in reference, Elliot, to the earlier question about seasonality related to this. And it's if the LRP is based on the futures price, then is timing important because of that it's based on the futures price?
Yeah, so I mean, you're essentially taking out a coverage price, right? And so you have to insure at a certain coverage level. And so when I talk about the seasonality or the timing, is more referring to the price you receive. So there is no seasonality in the premium cost. There's going to be seasonality in the underlying price, of course. And so when we talk about actually putting in a coverage level, you know, as that futures prices starts to erode, we can essentially only insure at lower levels now. And so that's when we're talking that if we're at historically high prices, relatively speaking, and we put in that, you know, if that price starts to erode or potentially change through time, we still maintain that high coverage price that it will potentially settle against. And so definitely things to, I think, consider and to talk through either your individual situations with myself or Jay Parsons, or even other people in your community about, you know, kind of expectations moving forward.
Okay, well, thank you very much, Elliot, and thank you, Jay. We're bumping up against our hour here, so we better shut this down. I'm thinking we could have this conversation for a while, though. So I want to extend a special thanks to Elliot and Jay for joining us. Also want a special thanks to Phil Erdman for working behind the scenes to put this together. Thank you, everybody. And with that, we will shut this down, and please have a good rest of your day. Take care.